Hello and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. When the Federal Reserve makes a move, it's not just a headline. It's a ripple that touches nearly every corner of our financial lives. Mortgage payments, credit card interest, car loans, and even the returns we earn on savings accounts, none of them operate in a vacuum. The Fed's most recent decision to cut interest rates is no exception. For many people, the news felt both promising and confusing. Lower borrowing costs sound good, but reduced yields and market volatility can quickly muddy the waters. So today, I want to unpack what this rate cut really means for you. We'll look at how it may affect debt, savings, investments, and your long-term financial strategy. Along the way, I'll reference an insightful NerdWallet article titled Fed Trims Rate. What does it mean for you? My goal is to help you walk away with more clarity and confidence no matter where you are on your financial journey. Let's start with the basics. In September of this year, for the first time in 9 months, the Federal Reserve lowered its benchmark federal funds rate. Specifically, they cut by 0.25%, bringing the target range down to roughly 4% to 4.25%. Now, what does that mean in plain terms? The federal rate is the interest rate banks charge each other for overnight loans. When the Fed reduces that rate, it lowers the cost of borrowing throughout the system. Over time, banks tend to pass those savings along, lowering the rates you and I pay on loans and credit cards. But here's the catch: nothing changes instantly. Rate cuts take time to filter through the economy. You probably won't wake up tomorrow and see your mortgage rate magically drop. Instead, it's more like turning down the thermostat in your house. The adjustment happens gradually. So why did the Fed make this move now? Chair Jerome Powell described it as a risk management cut. I like his analogy. It's similar to tapping the brakes when traffic ahead looks like it might slow down. You're not in trouble yet, but you'd rather ease up than slam on the brakes later. The key factor behind the decision was the labor market. We've seen signs of softening with slower hiring, rising unemployment numbers, and some downward pressure on wages. The Fed made it clear that protecting jobs has taken priority. Inflation is still a concern, but right now, preventing the job market from weakening too quickly is the bigger focus. This move is about striking balance, encouraging economic stability without fueling runaway inflation. What's particularly interesting about this cut is that it wasn't unanimous. A new member of the Federal Open Market Committee, Stephen Moran, voted for a larger half-point cut. Dissent within the Fed isn't common. When it does happen, it tells us just how tricky the economic picture is. Inflation hasn't fully cooled, the labor market is showing stress, and political pressure is mounting. Even highly trained economists looking at the same data can come to different conclusions. For everyday investors and retirees, that's an important reminder. If the experts don't agree on the perfect path forward, we shouldn't expect a one-size-fits-all answer for our own finances. Now let's look at what this move means for your personal financial situation. The first and most obvious effect is borrowing. Lower rates may translate into cheaper loans. Over time, you may see lower interest rates on credit cards, auto loans, personal loans, mortgages, lines of credit. If you already have debt, this could open the door to refinancing. For example, if you have a mortgage with a 6% rate and lenders start offering 5% or 5.25% refinancing options, the math might work in your favor, but it's never automatic. Closing costs, the length of time you plan to stay in your home, and your overall financial strategy all come into play. The same goes for auto loans and personal loans. If rates drop significantly, you may be able to refinance to save money, but the savings have to be weighed against fees and the bigger picture. Of course, lower borrowing costs could mean lower returns for savers. Banks may reduce the yields they offer on savings accounts, CDs, and interest-bearing checking accounts. That can feel discouraging, especially for retirees who rely on these vehicles for predictable income. If your CD ladder or high-yield savings account suddenly offers less return, that income gap needs to be addressed. This is where working with a financial services professional can really matter. Adjusting allocations, exploring alternative fixed income products, or rethinking timing strategies may be necessary to keep your income on track. What about the stock market? Rate cuts often create mixed reactions. On one hand, lower rates can boost corporate profits. If borrowing is cheaper, companies can expand, invest, and hire more easily. That's good for growth. On the other hand, investors sometimes worry that cuts signal deeper economic problems. If the Fed is stepping in to soften a downturn, markets may react with caution. We saw that right after this most recent cut, when the Dow briefly dipped before recovering. For long-term investors, the lesson is clear. Markets will react in the short term, but it's your broader financial strategy that matters most. Another common question is whether this cut is the beginning of a trend. Will the Fed cut again? The answer is maybe. Powell called it a meeting-by-meeting situation. That means the Fed is leaving room to respond to new data. Their own projections suggest additional cuts could come later this year, and futures markets show high odds of that happening, but nothing is guaranteed. Powell himself admitted, "It's not incredibly obvious what to do." That honesty underscores how unusual this moment is. The economy isn't in crisis, but it's not firing on all cylinders either. The Fed is trying to thread a needle, and that means flexibility is the name of the game. Let's make this concrete. Here are a few examples of how the Fed's decision might play out in real life. Young family with debt. A couple with credit card balances may benefit if their card issuers lower rates, but the bigger opportunity could be in refinancing a mortgage or auto loan, freeing up monthly cash flow. Pre-retiree with savings. Someone approaching retirement may notice their CDs and savings accounts paying less interest. That makes it crucial to revisit fixed income strategies, perhaps incorporating products that offer more predictable income. Long-term investor. For someone focused on a 20 or 30-year horizon, short-term market jitters may not matter much. Staying disciplined through the noise is often the smartest move. Each of these scenarios reinforces the same point. The rate cut is a tool, not a magic bullet. Its impact depends entirely on your financial picture. One area to look closely at is housing. Even if you're not planning to buy or sell, housing often reflects the health of the broader economy. Lower rates may encourage more buyers, which could keep home prices high. But if the job market weakens, demand could soften. For prospective buyers, it's less about timing the market and more about ensuring affordability fits into a long-term strategy. For current homeowners, the question is whether refinancing makes sense given personal goals and timelines. The takeaway from all of this is simple. Don't react to a headline, react to your own situation. The Fed's decision sets the backdrop, but your financial goals, your debt picture, your retirement timeline, and your risk tolerance should drive your next step. What works for one person may be the wrong move for another. To recap, in September of this year, the Fed cut interest rates by a quarter point, lowering the federal funds range to 4 to 4.25%. The main goal was to cushion a softening job market while still monitoring inflation. Borrowing may become cheaper, but savings returns may weaken. Markets can react in the short term, but your long-term strategy matters more. Future cuts are possible, but nothing is guaranteed. The bottom line is that this cut won't transform your financial life overnight, but it does shift the environment your money operates in. And knowing how to adjust, and whether it's through refinancing, reallocating savings, or simply staying the course, can help you make smarter, more confident decisions. If you have any questions about the new generation retirement system, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.